welcome everyone to this great event. My name is Spencer High and I'm the Director of Member Engagement here at SCORE. We got a great program for you, so looks like the majority of people have joined, so I'm not going to waste any time. I'm going to introduce Steve Peterson. He is the broker owner of Infinity Investments, and he is the past president of NorCal CCIM from 2018. So welcome, Steve. Go ahead.
Thanks, Spencer. Really appreciate it. And I really appreciate all you guys for taking your time to join us today. And we got a real exciting program for you. We're going to be talking about CCIM analysis in the 10-year cash flow model. And we're going to be giving you an overview of that and talking about the process. So I'm really excited, for you guys today. This is a thumbnail, a very introductory summary, if you will, of the CCIM cash flow model and the CCIM, we call CI 101 investment analysis course. So I think you're going to get a lot out of it today, but just know this is just the tip of the iceberg. We have in-depth courses you can get involved in it and learn this information at an expert level. But getting this fundamental information is going to make you relevant. It's going to make you specifically able to guide your client through a commercial property, whether that's 10 units, 100 units, an office building. It's going to make you dangerous and allow you to be able to do business. Okay, and so what we're going to go over, the class is going to be broken up into two sections. The first hour, Helen Chong, our current president of NorCal CCIM, is going to be talking about the differences between residential and commercial real estate, introduction on the income approach calculation. She's also going to talk about the real investor journey portfolio building. That's going to be exciting. And then she's going to give you an overview on how to use the CCIM model to analyze commercial real estate deal. Then we're going to do something pretty fun is we're going to break out for about 10 minutes in breakout sessions. The goal of this is to spur networking. A big part of what we do at CCIM is we have structured networking in almost every event, every class, everything that we do. Networking is ingrained. And so we're going to do that online for about 10 minutes, and we're going to have some fun in the breakout sessions. The second hour of the class, what I'm going to do is go over a case study. We're going to look at a real property that is currently listed in your market, yes, in San Jose, and we're going to break it down using the cash flow model. We're going to look at the operating memorandum that the broker has eloquently provided, and then we're going to break that down into the CCIM cash flow model. Then what we'll leave is about 10 or 15 minutes for questions and answers. I'm sure you guys are going to have a few of them so we can get some engagement, and then we'll wrap right on time. So with that being said, well, let's get into it. And just a little bit about myself, in case you guys don't know, a lot of people, you don't know me. Again, my name is Steve Peterson. I'm the broker owner of Infinity Investments. We're a commercial real estate brokerage and investment firm based in Oakland. We started in November 2009. So we've been around the block. I also was the past president of the California Association of Real Estate Brokers, and that was in 2017 and 18. That is the state board of NAREB, the National Association of Real Estate Brokers. I also was the past president of the Associated Real Property Brokers. That's the local Oakland chapter of National Association of Real Estate Brokers, which is the Black Real Estate Brokerage Association. Now, also served as president of NorCal CCIM in 2018. A major honor and a pleasure to have done that. The first African-American to do so. And NorCal CCIM, let me just say this, has been a founding pillar in me building my brokerage and my commercial real estate practice. So a little bit about me. I'm going to shut up now because the headliner today is Miss Helen Chong. And she's going to tell you, well, I don't know, Helen, if I could do you justice, but I'm just going to kind of summarize who she is and she'll get into it. Helen's a CCIM.
Oops, sorry.
Yeah, and she speaks, is it 5 languages or is it 4 languages?
4.
It's Cantonese,
not yet 5.
Mandarin, Bahasa Indonesian, and of course English. And she is our president. She runs her own team. one thing that's not on here is she is a mother of three, and yes, she is an active mom, and she gets the job done. And she's also been on the board of directors of SCORE, and is an avid investor, not just a broker. She's an avid investor. So this woman knows what she's talking about. She is leading the field in not only her company, but also in our industry. So guys, give a very warm welcome for Madam President, Ms. Helen Shaw.
Thank you so much, Steve. Gosh, you're making me blush here. All right, so let me see if I can switch over. You see next screen. Are you able to change that spotlight of the video? Let's see, maybe it's this one. Okay, there. So I think everybody, you can see me now. So, well, welcome. I'm very excited. As a matter of fact, just did this class last week with Merced County Association of Realtors. So I don't know how many of you have attended that one, but it will be very similar as last week's class. But this time we're adding the second hour where you can actually practice how to fill out the form. Now, Spencer should have emailed you guys this form. If you have a chance, please print it out now. And then also a reminder, if you are on your phone, I would highly suggest that you switch to computer, because we are going to have a lot of numbers and you're not going to be able to see it if you're on your phone. So I thought it's very important because to talk about the journey from residential to becoming a CCIM, because I think a lot of brokerage always talk about like you can either be residential agent or commercial real estate agent. And people always ask me this question, which one do you prefer? And I said, I cannot choose. I really do love both. And to give you a little journey about like how I went from residential agent to become a CCIM, you probably saw earlier behind my name, I have all these initials. It was because when I was a residential agent, I really truly have I took a lot of classes. The education was very important to me, so I keep getting destinations. And then I started taking CCIM class in 2013 when I had my second child. He was still a newborn, and it took me 4 years. Average is about 2 years to 3 years to finish, but it took me about 4 years to complete, and I got my destination PIN in 2017. And but I've been involved with the chapter since 2013, and this year I was admitted to the JWL Leadership Academy. Very, very proud of that. And I get to meet a lot of these leaders in the country. And also, of course, as Steve Peters had mentioned, that I am serving as the president for the chapter this year. I cannot use my clicker. Every time when I'm doing the class, I cannot use my clicker. It worked earlier. All right, next one. There. All right, so now residential and commercial, of course, residential, we acted a little bit more like a counselor, right? Because we see clients so happy, so excited when they get their first home, and they're willing to pay a little bit more to get their house, because it's a very emotional process. And this is why I love doing residential transaction, because I love seeing how happy they get when they find their home for their families. But then commercial wise, it's all about numbers. We don't even, sometimes we don't even go out to look at homes. For example, today, we are just like about to write an offer for a client who lives in Hong Kong. He doesn't even see the property. He knows the area already, but then he's like, okay, this is like my 5th property. I don't need to come over to look at it. I just need the numbers first. So it's a lot of numbers. And this is what we are trying to show you today. How do you run these numbers before you recommend a property to your client? And why I love residential and commercial. So I want to show you guys the difference, right? Let's see. Okay, so their valuation difference, residential 1 to 4 units, obviously it's using sales comparable analysis. Gosh, where's the clicker? Here we go. We use comparable sales analysis. So what it means is that whatever your competition selling the property for, that's your value, and then plus maybe some kind of remodeling that you add on to it, right? So we all know that 5+ units is all about net operating income, because investors are buying that property for the income. So the property value based on net operating income divided by the cap rate. The more money the property makes, so net operating income, higher net operating income, the higher your property value is. And a lot of people always ask, so what does cap rate mean? So the easiest way for me to explain to my clients a lot of times is that just pretend that you're buying this property with all cash. And what is the return on investment during your first year? So that's the way I explain to my clients, and then they get it. Now, just saying like, okay, you're buying this property at this cap rate and keep this cap rate doesn't really mean anything, because at the end of the day, you're really comparing your property cap rate versus the market cap rate in the area. So the nicer the area is, or the tenant's profile is nicer, or the property is in a better condition, the lower the cap rate. So just remember, the lower the cap rate, the higher the property value is going to be. So let's say if the area is 5 cap area, and then you're looking at this offering memorandum and showing that it's a 4.5 cap, then you know that you're actually buying a little bit more expensive than what the market is providing. So may not be a good deal. But if that property, the cap rate is about 6 or 7%, then you know that hey, maybe that's a good deal to look at. Okay. Now, I've been watching Bruce Lee a lot. I see, I'm kind of into this whole Kung Fu thing these days. I watched the documentary Be Water. I don't know how many people have watched it. It's through ESPN. And I love how Bruce Lee has these philosophies. And one of them is that I fear not the man who has practiced 10,000 kicks once, but I fear the man who has practiced one kick 10,000 times. So what I'm trying to say is there's so many different ways to do your analysis. And you probably hear like this version, that version, this version, that version. But you gotta just pick one and practice it and practice it and practice it. We, like for me, Steve and I, we chose CCIM because we feel like this really does the best job for our clients when we explain to them. So that's why we chose CCIM. And this is all we do over and over and over again, every single time when we find a property and do due diligence for our client. Okay, so now I want to share with you guys, like, how do you go from residential agent to commercial? How is it like really going to help you with your business, right? So again, a lot of us here, we started up as residential agent. And I had a client also I met her 10 years ago. She was a mother of 2, and she just moved to California. And she said that she really wanted to start this investment. So I actually showed her a property in Yorba Linda, which is a condo. And this condo, she purchased it for $260,000 and a rental income $2,000 per month. Not bad. And 4 years later, she sold it for $394,500, which is not bad either. She made some money. And then she exchanged it into a single family in Anaheim, which is close to Disneyland. And she decided to do Airbnb. She purchased it for $575,000, 4-bedroom, 2-bath, and rental income is $7,000 to $10,000. I mean, that sounds like a great, really great cash flow property. She absolutely loved the cash flow. She just hated the management for the Airbnb. So she decided to sell it and sold it for $740,000. And then I actually suggested her, why don't you look into triplex, like multi-units, because if you don't have income, at least you have a couple other units to help you with. So we found this property in Santa Monica for 1.3. It's actually Venice border. And rental income at the time, the owner was running an Airbnb again for $17,000 per month. And it was a great, great, great property. And then she got really great cash flow. Again, because of the Airbnb rules and regulations in Santa Monica, she decided that, you know what, I'm just going to sell it. She sold this for 2.035. But if I used at the time, if I have used the net operating income, the income approach, like a 5+ units, this probably should have been about $2.3, $2.4 million. And even at 2.035, we're stretching it. We couldn't even get it appraised because it's based on sales comparison. So for us to be able to sell it at 2.035 was actually pretty good. So you can imagine, like, she was a bit frustrated, right? So I explained to her how 5+ units work. And then so she got very excited. We found a 6-plex in Sunnyvale. And she purchased for 2.37, which is a 3 cap, extremely low. The rental income is $9,400. And then she raised the rents within 1 year to $14,300, and which was a 4.5 cap. And then in the cap rate in Sunnyvale at the time was like 3 and 3.5. So a lot of you probably know that it's very low over there. So just by increasing the rent in this area, she was able to increase the property value by $1.68 million. So after that, she was hooked. She sees the benefit of income approach. So then next property we showed her was the 7 units in West San Jose, bought it for 3.3. Again, it's a 3 cap with $17,800 per month rental income. But what's special about this is that it was built as condos. So, but then it was used as apartment. So we still use income approach to value this property. At the time, if you have bought a condo in that area, it was about $600,000 per unit. So, which is $4.8 million value, right? And I'm sorry, it should be 4.2, typo, 4.2. And then in 2019, the townhouse over there in that area, West San Jose, was actually selling for $900,000 conservatively. So you can see that how much equity she has gained. If she had just spent some more money and converted into condo or townhouses, she would have gained a lot more money. But right now she's very happy. She's getting the cash flow right now. Although financing wise, she needs to have, she needed to put down 50%. So she's not really getting a lot of cash flow from it, but she's so excited. So she was like, well, I want to buy more properties. And as a real estate agent, sometimes we act more like a consultant. So I actually told her that, you have bought these properties, your cash flow is pretty tight. How about we look at somewhere else with a higher cash flow? So she knows that I invest out of state. She followed me to Kansas City, and we found the 77 units in an area that is developing. So we said, like, this is going to be a long-term hold. We buy in an area next to a Class A neighborhood, but this particular one is actually in the Class C area. And we purchased for $3.56 million, but look at the rental income. Is $43,854, and you're getting 11 times more units compared to the one in West San Jose. So this is the difference, right, between high cap rate location versus a low cap rate location. Now she has a lot more cash flow for this property. So the area, remember we said that because this is a Class C area and we know there are a lot of developments going on in this area, the cap rate in the future, we expect that it's going to come down around 6%, because in other parts of nicer neighborhood, they are selling at about 6%. So with that said, if the area does improve and with the rental income, let's say, never change, the property value is actually about $5.2 million. And that was the reason why we continued to buy multifamily. And this is just a few properties I picked out from her portfolio to show you guys how I helped a client from condo, investing in condo. Eventually, she now owns hundreds of units and become a very, very savvy investor. But she's so loyal that because she sees that every time I run my analysis, I use my CCIM analysis. She loves the fact that I am not selling her a property. I am running my analysis, and I gave her consultation to see if this property makes sense or not. So with that said, I want to go into exactly how we went from finding a property to how we run the numbers on our spreadsheet. Now, if you're not good with numbers, I have a warning here. You might fall asleep because it is a lot of numbers. Or if you enjoy this, you might have a headache. I always show this. This is the book that we use. Typically, a CI 101 class is a 4 full days class. So it's like I think 8 hours a day, 4 8-hour a day class. We are making it short into like only 45 minutes. So just bear with me. You could tell that I'm trying to speak a little fast because there's a lot of information here that I want to share with you all. So how to review a deal from start to finish. First of all, you usually, when you find a property, you get this, what we call an offering memorandum from the listing agent. Now, as a listing agent for residential, we do staging, we package the property to look very nice so that our buyers walk in, they get emotional, right? Now for commercial, is that we don't really, well, I mean, we do a little bit of like the curbside appeal, mow the lawn and stuff like that. But more importantly is that before they walk in, they want to see the numbers. They want to look at the numbers to make sure they look good. So they will provide in the offering memorandum, typically there are a couple pages that's most important. One is the rent roll, and then another one is the financial analysis. So they look something like this. Now, what do we do with these numbers now? So this is what I usually do to start off with. Before I go into my 10 years analysis, I go into a quick analysis first. So first of all, I'm going to walk you through this. This is typically, I mean, right now I'm going to go through a little bit longer period of time to explain this, but once you get this, it can be as fast as like within 2-3 minutes. You can just do it on a napkin. We call napkin analysis. So now I know that they're asking 4.1, but I'm targeting at $3.9 million purchase price. I know the average rent by looking at the rent roll is about $526 per unit. So that means the current rent, monthly rent is $43,854. But I also know that the pro forma rent is around $610. So the future rent is about $46,923. Now look at it, it's like, hey, it's only about what? $80 increase on the rent. It's no big deal. So now let's take a look at it. But the annual rent wise, you actually increased by about close to $40,000. And then because this is a Class C properties, I typically use a very quick 45% ratio as an expense ratio for Class C properties. Class B, I might use a little bit lower number, but Class C properties, I usually typically use 45. Some people might use 40, some people might use 50. 45 is just my number. And then so I was like, okay, let me estimate about 45% expenses. That way, annual rent minus expenses, I just get my net operating income, $289,000. And then the pro forma, what I'm expecting it can get would be about $309,000. So this is about $20,000 difference in terms of the income, what it is now to what it might be in the future. Now, if I know, because I know that let's say the market cap over there is 7 cap, then if I use 7 cap based on the current net operating income, then it's about $4.1 million value of the property, which makes sense if I compare it with the asking price. But future rent will be worth about 4.4. Now, if I do it in another way, it's saying that if I buy this property at $3.9 million, that means the cap rate I'm buying it at is $7.4 million, which is actually a higher cap rate compared to what the market cap rate is. So it is actually a good deal for my clients. So that way, now that I look at this, I was like, okay, I think this is a good deal, and I'm going to recommend this property to my client. Any question right now? You guys all good? All right.
Ellen, there was
So
a
now,
question in the chat. There was a question in the chat asking where can they find the CCIM analysis Excel sheet? Is that just the template that Steve shared? Is that what they're referring to?
Yeah, so the CCIM analysis, if you are a CCIM student, then you will be able to get it. If you take that class, then they will share, the instructor actually will share that with you.
Okay, thanks, Helen.
And yeah, so Steve Peters actually only shared with you the first page, and I will show you, actually this is what I'm going to go into, is the page that Steve Peterson had, is going to show you later on. All right, so now we are going into, because this is a property I will recommend to my client based on my quick analysis. Now I will do my 10 years analysis. Now I'll go back to the listing agent's financial analysis. This is what they have. And then I'm going to take these numbers and input it into what we call APOD. It's the annual property operating data, which is what you guys should have received in your email, and then you guys will fill it out later on. This is typically the first thing we fill out. And you'll see that these are the numbers, and I will blow it up here. This next page, blow it up for you guys to see. Everything, we were just kind of like transposing the number to this side, and with our own assumption as well. But then there are a few things that you have to pay attention to, is that, for example, real estate taxes. A lot of times you'll be surprised that listing agents actually don't put the right real estate tax. They still put the current real estate tax, not assuming that, you know, the real estate tax will increase by the time you buy the property, right? So that can make a big difference in terms of your net operating income. So this is what you see from our analysis. It should be about 39,000, but they only had 16,194. So there are going to be some numbers that will be different. For example, when we talked to our insurance person, they told us that this building is about $20,000 quote. So we adjusted that, 30,000 versus 20,000. And then also the management expenses, they put down 48,118 here. And we did like a 5% offsite management fee plus the payroll, because if you 77 units, you most likely have an on-site person as well. So we're gonna add in like the payroll cost on there. Lastly is that now you see that the difference between our number and their number is that the their total expenses is $260,000 and ours is $285,000. So you see that there is a difference between their numbers and our number. And this is why you have to run this annual property operating data sheet to make sure that you have put in the right assumption there. Sometimes it's kind of hard to do like electricity, water, and gas and trash removal. These we typically just get it from the sellers, but then the other stuff, for example, operating reserves, we would put in our number in there because this is what the lenders is going to use anyways. So with the numbers in here, now we can do a better job in advising our clients whether this property, the numbers shown by the listing agent makes sense or not. Now, we mentioned just now that before I move on to the next few sheets, we have to do assumptions when we do our analysis, right? This is what we are predicting for our clients, how well this property is going to do. So there's this sheet where we're going to have to predict what is the vacancy ratio in this area. If you know, then you put down the market vacancy ratio, and I put down 7% here. If it's a Sunnyvale, we might put down lower numbers, 3%, 5%. And the rental income escalator, this you see that the first year we did 7% and then 4% afterwards. The main reason is that we saw there's some like under market rent in a lot of the units. So we saw that there is a potential to raise rents. But you also have to be careful, depends on where you're buying. If you're buying in an area where there is rent control, then you better make sure that this number is not unrealistic for your clients to do in the first year. So you need to make sure you look at the numbers, look at the cities where you are to input your assumption here. And then of course, and then there are other income escalator, meaning maybe laundry, parking, or storage income. And expense escalator also, I just kind of usually just do 3%, and assuming that expenses will just increase every year, 3%. And also the cap rate. This is what we use for assumption for us to determine what is the cost going to be, what is the cap rate is going to be by the end of 10th year. So I always run the 10 years. There are like 5 years. I think that's what Steve Peterson is going to show you guys. I typically run the 10 years, assuming my client's going to hold it long term. But if my client says, I know I'm not going to hold it more than 5 years or 6 years, then I will do a 5-year analysis. So this is just a assumptions like, okay, when my client's going to sell, I assume that the cap rate at the time is going to be either 6.5%, 7%, or 8%. So now you are giving 3 different scenarios: aggressive, moderate, and conservative scenario. And also the expense of sale could include closing costs and also commission. And in here, we have the income tax bracket. Depends on your client situation, which tax bracket they're in. Capital gain tax rate, and then also the straight line recapture. This is basically the tax on the depreciation you're taking during the ownership of the property. Okay, so a lot of times these assumptions, I have to make sure that my client and I, we're on the same page. They might come back and say, no, I want you to use a different assumption percentage here. Then we will adjust it accordingly. All right, so next one is, as I mentioned, it will be 5 or 10 years. Now this is what very important for us to show our clients. This is a 10 years cash flow based on whatever we input, the assumption, the APOD that we inputted, then it spit out these numbers on the back end. Now, to remind you guys though, when I took this CI 101 class, I did not use a computer or Excel spreadsheet. It was this loose sheets like this, and then I would fill in every single cell from the first page all the way to the 5th page. I handwritten them, I calculate them with a calculator, and I want to make sure that I know what every single of these numbers mean, and then I write down everything on your forward. So this way, now I understand why we have these numbers here. When you first start, and this is also another reason why we don't want to share the Excel spreadsheet with anyone, because if you just start with okay, I'm going to have the Excel spreadsheet, I'm going to let the Excel spreadsheet to auto-populate everything, you're not going to learn, understand, and how to consult your clients based on these numbers. So this is the reason why I'm very excited about this page because every single number is actually means something for our client. Now this page, it has 3 different sections. One is the mortgage data. Next one is about the taxable income and the cash flow. And also you'll notice that on this one, we have an 11th year number. The reason why we have an 11th year number, because we want to know if we decide to sell the 10th year, then we needed the 11th number to calculate what our 10th year sales price is going to be, right? We needed the net operating income in order to calculate sales price. This is why we have the 11th year number. And then also here is the cost recovery data. Cost recovery is basically depreciation. Now the useful life for residential property, no matter it's 1 to 4 units or 5+ units, as long as for residential use, is 27.5 years. But if it's a commercial use, that's 39 years. So in a way, residential use, you get more depreciation write-off. So this is also another reason why a lot of people like to invest in multifamily. Now, if we zoom in a little bit, the mortgage data here, this is before I even talk to a lender. I already have an idea how much down payment my clients need to put down in order to buy this property. So I don't always have to go back to the lender. Instead, I do my analysis and then I will send it off to a lender and say, this is my analysis. What do you think? Does it go in line with what you're seeing? And a lot of times it does. And so if you see that we have the loan mortgage amount here with the interest rate, I kind of know what the interest rate is at the time with the amortization period. Now you see this one is 30 years because for this particular property, my client actually used a Freddie Mac loan, which allowed for 30 years amortization period. And also they allowed us to have a 10 years loan term, which is 10 years fixed. So for 4.2. So the monthly payment is $14,685. And if the annual, whole year mortgage payment is $176,000, and then the loan cost I just estimated here about $45,000. And then if the debt service coverage ratio is net operating income divided by debt service. So if I use the net operating income from the previous screen divided by the annual debt service here, what is saying that most lenders' requirement is that we want to see at least 1.25 coverage of the mortgage payment. So your net operating income is more than enough to cover your mortgage payments. So in this case, I see that it's 1.35. So it's more than enough to cover this with a $3 million loan amount. As a matter of fact, at the end, we did a 80% loan to value. So it was a little bit over $3 million. And cost recovery, we decided what is the, basically, again, I mentioned it earlier, it's for depreciation. Now, underneath where it says taxable income and the cash flow, I only zoom into the 3 years so you guys can see better. We are here to calculate the real estate taxable income because we want to calculate what is the cash flow before tax and after tax. It is very important because every year they still need to pay tax on this, right? So, so here is the net operating income. So these numbers actually pulled in from the annual, the APOT, the annual operating, property operating data sheet. So it pulled directly in here, and the first year, and then plus, I think with the rental income, we said 7% and 4% increase, and then calculates the net operating income. Then we have the interest for first mortgage. We minus that interest for first mortgage. And then also we minus the cost recovery, the depreciation, and also the amortization of loan fees. These are write-offs to get the real estate taxable income on here. Now, knowing what is their tax rate, now we know how much, approximately how much tax is gonna they're gonna owe to this to this income. But so, and then here we have the net operating income. Now we need to know, okay, so then what is the cash flow, right? We have the net operating income, but remember, net operating income does not include mortgage payments. So that's why we have to minus the annual debt service, which is the mortgage payment. Then we get the cash flow before tax. So net operating income minus your mortgage payments equals the cash flow. And then minus the tax liability here equals to the cash flow after tax. How many agents out there would really doing these numbers, right? But of course, we are not CPA, we are not tax preparer, and you have to let your clients know that this is just an estimate only. But at least when you do this, your client will be so impressed because not a lot of people are willing or able to do this kind of analysis for them. This is the one that after I finished my 101 class, I did this cash flow analysis. My clients she was just blown away. And since then, this is all we use for our clients. Okay, now the next one. Based on all those cash flow, now you know, right? Remember we had the 11th year net operating income. This sheet is called cash sales analysis, assuming you're gonna sell it at the 10th year. So at the 10th year, remember we had 3 cap rates that we talked about. So we're gonna use 3 different scenarios. So this was the net operating income from the 11th year that we calculated based on our assumption. And these are based on the net operating income and the cap rate. Now we projected what is the sales price going to be for these 3 different scenarios. So it looks like it could be as good as 7.2 or 6.7 or 5.8. Again, clients love this because you are not telling them, oh, your property is going to sell at 7.2. You're actually giving them 3 different scenarios. So they really can't argue with you because you are being conservative, you are giving them the best scenario or giving a moderate scenario. Okay. Now here a few different sections again. The first one is the calculation based on the adjusted basis. So of course, when you need to sell your property, you might have to pay the capital gain tax, right? So we need to calculate the adjusted base at sale. So this is what you had bought the property for at the time. Actually, it was 3.9 plus, I think, close to $100,000 of fees and things like that. That's why it came up to $4 million. And then minus the depreciation you had taken before. So that's why your adjusted basis is lower because you've taken appreciation every year for the write-offs. So now this is your adjusted basis. Next, we're going to calculate the capital gain on sale. Now, again, the sales price, we assume that it's going to be at 7.242 minus, we talked about 6% expense of sale, which is maybe the commission plus closing costs, etc. And then minus the adjusted basis, which is 3.027. Now we expect that this property is probably around $3.78 million gain. And then minus, again, this is straight line cost recovery. This is minus basically the depreciation that you have taken throughout the last 10 years. Now your capital gain is at 2.807. Now you know your capital gain tax. Now you can calculate what the sales proceeds, how much cash this client is going to get after they sold the property before and after tax. Why we do that? Because if they want to do 1031 exchange, then that's before tax. But if they say, oh, nope, that's it, this is my last property, I'm just going to pay for the capital gain tax, then you can calculate what is the sales proceeds they're going to get after tax. So you see that here is $7.242 million sales price minus the cost, the expensive sale, minus the mortgage payment because you have to pay off the lender. That equals to $4.4 million cash, the sales proceeds before tax. But if they have to pay tax, they have to pay tax on the depreciation that they have taken out before, which is a 25%, and then also the capital gain that they had earned. So that's total of about $800,000, and that's sales proceeds after tax. So if you show this to your client, you say like, okay, you're gonna be, it's fine if you don't buy anymore. You just need to pay $800,000 of the tax. A lot of clients probably say, oh, never mind, just roll it into another property. I don't want to pay $800,000 worth of tax. So this is why it's so important for them to see what will happen when they sell their property. All right, so again, these are the 3 scenarios that we do. So they could be 4.4, 3.9, or $3.1 million cash that they have at the end of sale. Now, at the end of the day, I always say that really our clients just want to know what is the IRR of this property. Cap rate, remember, is very different from IRR. Cap rate is just talking about the first year, assuming that you're doing it with cash, but most people do financing. So that's not your cap rate, that's not your IRR. So we use a T-bar to calculate IRR based on the three different scenarios: the most aggressive, moderate, and conservative. So we remember the first year, the initial investment is about 1.042, and then these are the next 10 years of cash flow, plus the sales proceeds, the cash that we received by the time we sell it. Using the T-bar, now we know our IRR, the annualized return, is about 24.7% for the best scenario, or 23.77%, or 22.09%. Or if you pay tax on it, this is your return: 20.73, 19.78, and 18%. Now you know why my clients were so excited when we found that 77 units. They saw these numbers like, wow, and immediately they bought it, and they still own it until this day. So at the end of the day, like, this IRR sheet is very important, because some of my clients might say, you know what, as long as it's over 5%, I'm good, I'm happy. And some clients say, no, I need to see double digits. It needs to be at least 10%, or some might be at least 15. Now, this gives us a really good gauge on if we should move forward or not with that property. Okay. Is it too much information? Brain overflow right now? I don't know. Maybe when I finished my class, I was feeling like this. So I think I think this is a time where we are going to ease your mind a little bit before you start doing the practice with Steve Peterson. But so some of the residential agents would say, so how do I start doing multifamily deals? I mean, after this class, I still don't think that I'm ready. Why don't you just refer to a multifamily agent or partner with a multifamily agent to do the deal? 90% of my deals, actually maybe even more, almost every single deal of mine, I work with someone else. I don't just do it on my own. Because the reason is because I believe in teamwork. Talent wins the game, but teamwork and intelligence win championships. What is it that you want? You want to make sure that your clients are being protected, then find the talents within your team and make this work for you. I know sometimes a lot of people think that, oh gosh, I have to split my commission 50-50 with someone else, or maybe whatever percentage you're thinking about. It's better off for me to just do it on my own. It's kind of the same mindset. It's like, if you always focus on double ending a deal, making the most commission every single time, your client base is going to be like this. But if you can provide such a good quality of business, your client base is going to be like this, and your business will grow much more steadier and also much longer. So I would really encourage everybody to think about working with someone else who is expertise in that particular asset types, and then so that you can make the deal work. Now, I want to use a little time to share a little bit about NorCal CCIM. As you know, Steve Peterson and I, we are very active in this, in our chapter. We have a lot of events going on every month. Like last week, we just had a virtual mentoring session. It's free. Everything is free here. Today, we have this 2 hours intro. Last week, we had one with another association. And then right after this, by the way, right after this, I hope you guys can join us from 4 to 5:30. So we're going to finish at 3:30. But 4 to 5:30, we have a deals and drinks. And we all going to grab our glass of whatever, wine, beer, or hard liquor. And we're going to meet with each other, talk about their upcoming deals or their needs. And then we're going to go into breakout session and network with each other. I cannot tell you how important it is to network. With CCIM chapter, I built my business there in my commercial real estate transactions that I worked with a lot of people here. I worked on a deal with Steve Peterson last year, and it was great because we know each other. So it was amazing. If you do want to, maybe, I don't know if Spencer is still here, if he can type in the link later on.
I just put it in the chat. It's there
awesome.
for everyone to register.
Perfect. Then you can join us at 4 p.m. Just remember, we finish 3:30. You can go grab a drink and then come back. And then also every month we do a book club. We just had one 2 days ago, but every fourth Tuesday of every month at 8:30 we have a book club. So be sure to check out our website and then join us. Now, regarding destination courses, Steve, would you like to go over the destinations?
Yeah,
curriculum?
absolutely. And the designation, again, is is the highest designation in commercial real estate. And in order to get it, you've got to complete a series of classes: CI 101, which is financial analysis for commercial real estate; CI 102, which is market analysis, commercial real estate; CI 103, which is really good. It's user decision analysis. User meaning like a business owner, someone who is buying property for business purposes. So that's user decision analysis. CI 104, which is advanced investment analysis. And you've got to take an elective course. Typically there's we recommend the negotiations elective course. It's really applicable to the business. And you've also got to take an online ethics course. Really important here at CCIM. We're really big on ethics. Now, once you've taken these courses, in order to take the test to become a CCIM, you have to submit your portfolio. And this has changed over the years, but typically what this is, your portfolio of work. And you have to show deals that you closed. And when I got the designation, you had to show $10 million worth of transactions over 10 separate transactions within the past 5 years. So from the time you submit, going back 5 years, you have those deals, those transactions that closed during that period of time have to at least equal 10 million, and it has to be 10 separate transactions. Now, you got to document the deals, closing statements, how you got paid, and a quick summary on the CCIM skills you use. So it's rigorous, but it is absolutely worth it. Once you submit your portfolio, then you will be allowed to take the test, which is I think it's a 6-hour or 8-hour test, pretty in-depth, and it is recommended to take, there's a 2-day refresher, right? You take that right before you take the exam, and that is the preferred way of going about getting your CCIM designation. Once you get the designation, and even before you get the designation, you want to make sure you're networking with the local chapter wherever you are, because that's where the business and the money happens. What we're doing this whole thing for. But absolutely advise everyone, take some time. If all you did was take one course, that's CI 101, it's going to change your life, both as a broker and agent, and probably more importantly, as an investor. We all need to be investing in real estate in some capacity. As this is our business, we should be investing in it. And it's going to absolutely increase your awareness, understanding, wisdom, and knowledge. Also, your network by taking that class. So I highly recommend you do so. And typically we always have in-person classes in San Francisco and the Bay Area, typically 2 or 3 times a year. Obviously we're pivoting, and so a lot of the courses are available online. And so check it out, and check out the website and see what we've got coming up next.
Absolutely. Thank you so much, Steve. And next one, just one more, is that I want to share with you guys the leadership. These are most of the past president. I'm the current president, and also our future president. Tim Tran is going to be our president for 2022. And I just wanted to share how diverse it is. And then every single person in here, their true leadership, not just within our chapter, but within the commercial real estate or industry. And I mean, you already heard what kind of position Steve Peterson had held. And oh my gosh, David Pio, he was one of our youngest presidents at the time. And he actually also just became our institute instructor. So he'll be teaching CI 101 along with Bill Moore, who's our senior instructor. I forgot how many interviews he had gone through, but it was a very, very vigorous interview, to get there. And Mark Hinkins is also present for a lot of different organizations. Steve Edrington spoke with us on our webinars, teaching classes about rent control, eviction. He is a really big advocate of like these regulations regarding rental housing. And Aziz, he's a leader in the KW commercial. Eric Wren, he's also really big in the industrial sector. So he's known, very popular, very known speaker in the industrial sector. And of course, and Tim is very well-known industrial broker in Fremont. So this is all I want to share with you guys. We are getting ready to go to breakout session. If you guys ever have any questions to, about CCIM, about analysis, feel free to contact me. And so, Steve, are we ready to go into breakout session?
We as ready as we gonna be. And so here's what we're gonna do, guys. And we're only gonna do this about 10 minutes, but this is our effort to spur networking. Remember, every class you take, every seminar you go to, if you're in residential open houses or mixer, whatever, is an opportunity to meet, maybe someone that you will do your next deal with. And so that's what we want to accomplish. Now, we're in the pandemic, so we got to do it a little bit differently. So we're gonna break you guys up into breakout rooms now. It's just gonna be automatically, there's gonna be 6 to a room. The goal is for you to meet the people in the room. I believe it lasts for about 5 minutes and it's gonna automatically switch. We're just gonna have 10 minutes of this. Give your brain a quick break before we fill out the information. More importantly, so that you can meet the people who are taking this class with you. Like-minded individuals wanting to learn the same thing. I've closed a deal with someone in every single CCIM class that I've ever done, every single one. So, and some of those were some big deals. So make sure that you ask questions about who's in the room with you, get to know them, exchange contact info, and then we're gonna do this for about 10 minutes, and then we'll get back and into the fun part and doing some more math and seeing how all this stuff ties together in a real world transaction.
Well, I see that most people are coming back in here. Okay. I was just been chatting with Charles Goodman here, and I have to tell everyone that Charles is an investor, very, very avid investor, owns a lot of buildings, and he and we were actually CCIM classmates in one of the classes. So we were just talking about how CCIM analysis had been so helpful for him for his purchase. Do you want to say something for everybody right now?
Yeah, I never took the exam and got pinned because I didn't have the transactions within the 5-year period. So all the stuff we buy and hold long-term. And I didn't take the CCIM program, although I completed the entire program academically. I took it, the reason for taking the program was so that I would be better at my own analysis for my own investment and also to consult with others. So that's my main focus.
That's awesome.
Yeah.
That's what it's all about.
It's a great tool. It's a complex tool. It's drinking from a fire hose. Like you, all the
right
through it, like, oh my gosh, 5 days and you're overwhelmed, and then homework, and it's a lot, but you get a lot out of it. It's really tremendous.
Well, thanks
and
for
these
sharing
guys,
that.
Steve and Helen and Bill Moore and all the people associated with the Bay Area are super supportive and very available to assist you if you need it.
Absolutely.
Worth the time and money for sure.
Well, thank you. It was really good seeing you, Charles. So now I'm going to turn back to Steve.
Okay, guys. Well, look, I hope your breakout room was as productive as mine. Everybody met everyone and had a chance to talk about what they're doing, and there might be 2 or 3 deals that came out of that. So that's what it's all about. Now, speaking of deals, I'm gonna run through this quickly and as high level as I can. Helen broke down specifically what we're doing, and now we're gonna go about doing it. Okay, and so here's what we're doing. We're gonna look at the Comar Apartments, which is a 42-unit building currently listed in San Jose, California. So here's what I'm gonna do. I'm gonna share my screen. I'm gonna show you the OM so you can take a look at it. Then I'm going to, as opposed to doing a split screen, I'm just gonna go back to the APOD and fill it out. I'm gonna read to you the numbers off the OM, but I just want you to see the OM, for a quick second. Some of you guys are experienced veterans. You've been around the business forever. Some of you guys are just getting going. So I wanted to kind of make a level playing field and make sure everyone has a chance to kind of see what we're dealing with. Now, Marcus & Millichap, probably the biggest apartment brokerage in the country, certainly in the South Bay, is bringing this listing, the Comar Apartments, 42-unit building. Now, when you see an OM offering memorandum, also called the marketing package, it's just the package of information explaining the financials, explaining about the property. There's a lot of pretty stuff in here, a lot of pretty pictures, but we want to go into the nitty gritty. Okay, so here's a quick summary of the property. It's 42 units. You see here, it's 12.5 million. All right. So what they're saying, a 35% down payment would be a 65% loan. That's typical. Okay, they're running their loan at 3.5%, which is what we're going to use. They are quoting a 5.31% cap rate. All right, they are quoting a 663 net operating income. And of the 42 units, it's a very unique mix. 41 units are 2 bedrooms. 41 unit is a studio. I've never seen that mix before. Every book, you learn something new on every book. So just kind of showing you that, you know, the demographics, all that stuff, you can look at it. I always like to go right to the meat and potatoes. And so here's what I mean by meat and potatoes. Although nice roof on this place. I go first to the rent roll. Now, as you'll see here, this is a super summary rent roll. The rent roll Helen showed you in the previous example was much better. Now, here's the first thing I want to tell you. Get the OM, but you want to ask specifically for the rent roll separately in the last 2 to 3 years profit and loss statements, because they're going to give you what, and you'll see why that's important, but they're going to give you the numbers in the OM, but you want to get the actual statements, which sometimes they won't give you until you're in contract. But we always ask for it up front, typically after though we've done this analysis. But I always like to try to get the rent roll up front if they're willing to give it, because I want to see every single unit, what that unit is renting for, when they moved in, when they moved out, etc. But for example's sake, we're going to use these numbers, okay? Of the 41 2 bedrooms, the average here is $2,029. Of the 1 studio, the average is $1,400. Interesting, because actually in Oakland, in a tough neighborhood in East Oakland, 2 bedrooms actually rent for $2,100 to $2,200. So when I saw this, I'm very surprised that in the Silicon Valley, rents are a little bit lower than you would now. This is East San Jose, so this isn't the best neighborhood, certainly not the worst, but just to give you some perspective. Now, what I'm going to be doing, guys, I'm going to show you this, and then I'm going to read from it. I'm not going to bounce back and forth. That's going to be too confusing. I just want to show you this now, and then I'm going to read from it and input the numbers into our own analysis, okay? So they've got, $1 million, 15 for gross rents. They've got vacancy. Notice here, physical vacancy, people actually moving in and out, and the physical vacancy loss. They have something called economic vacancy. Economic vacancy sometimes can be for an on-site manager that lives there, they get free rent. Sometimes economic vacancy could be, a rental concession. But then there's also economic vacancy called bad debt. There's people not paying their rent. So the total vacancy is 4.6. Kind of high for the area, but that's what we're using. So we're going to operate with that. Now they've got storage income and they've got laundry and vending income. We're going to input that into our analysis as well. Now, and that's a total other income number. Now their real estate taxes, you'll see here 153,049. I'm going to show you why this number is way off. Okay, then their insurance, utilities, they put all the utilities. When you're doing your analysis, you want to get each utility though. Garbage, water, gas, electric. You want to get a copy of that bill. Or just go off what they're saying as utility. Get a copy of the bill, okay? They put turnovers. These are unit turnovers and maintenance. I'm going to put these together in our analysis. Vendors, marketing, payroll, admin. So they got a total number of 316. Their NOI here is 667. Now, let me just show you something real quick. The NOI here says 667, 349. We're going to scroll a little bit. I'm going to scroll a little bit. I'm going to, because you can't, everything that glitters is not gold. This is 663. Little bit of thing, but there's a little bit of a difference there. Okay, this is another reason why we have to do our own analysis. Okay, so now, now what we're going to do is we're going to input the information into the APOD. I showed you the OM so you can see what it looks like, and then I'm going to input the information off of the OM into this. So first of all, I already kind of wrote Comar Apartments here, the location type and so forth. Now we're going to put in these numbers, 12,000,005. All right. Acquisition costs. I'm going to just say 1%. That number varies.
Oh, Steve, I don't think you're showing your spreadsheet right now.
Oh, okay. Wait a minute. Sorry, guys. Here's what I'm going to do. One sec. Now, we're going to screen share again. Hold on one sec, guys. Okay, now let me know if you see the spreadsheet. Good? Okay,
Yes.
sorry about that, guys. Now, purchase price is 12.5. The acquisition cost, I'm going to go with 1%. You guys know that's going to vary. Now, what they're quoting in the operating memorandum for the mortgage was 8,000,000, 1.25. So I'm just going to use their number of 8,000,000, 1.25. And that's a 65% loan to value. And we're going to say we have a great mortgage broker going to get us a deal where we're only paying 1 point on this thing. Okay. So the loan cost is only going to be 81,250. Obviously, this is going to, change from what's actual, but this is for our purposes. Now, real quick, since I just put the loan information, I'm going to come over here to the second page. You see how in the spreadsheet, there's multiple tabs. This is the first year. But for mortgage purposes, I'm going to go over here, okay? And I'm going to put the mortgage amount, 8,125. 3.5% interest, 30-year amortization period, 10-year loan term. That's what they're quoting us, all right? I'm also just going to put this here real quick. And we will have time for questions, okay, guys? Anybody who has some questions, we'll probably hold to the end, but you will have a chance to ask your questions, okay? All right. So you see the mortgage information and put it here. I go back to page 1. All right. So now we've got our purchase price, all the act fees, mortgage payments, and everything. Now, here's what we're going to do. We start with our top line number, potential rental income. Now, it's a calculation. So you see the bar up here, we put an equal sign. I'm going to go, now what I'm looking at is our rent roll summary. So we've got the 41 2-bedrooms that are renting at 214. 214 times 41. Plus, there's just one studio that's going to be renting, or wait a minute, hold on, guys. Sorry about that. I put 214. It should be, that's the weighted average, 229 for the 2 bedrooms. Now, plus $1,400. Now, that's what it looks like gross on a monthly basis. All we're going to do, times it by 12. This is going to get our annual number. Oh, wait a minute. Hold on here. Okay. Not times 812, times 12. There we go. Okay. Now, same top line numbers they have in their analysis. Same exact number. All right. Now, we put our vacancy rate of 4.6% here. And I've already kind of got that populated. So that gives me our actual vacancy, physical and economic. Now what I'm going to do here is put in our other income number. Their total other income number for their calculation is $15,482. All right. So that gets me effective growth of $983,857. Theirs is $983,584. Very similar. Here's where it gets real. Property taxes. Now, what we do is, first of all, you want to look up every property that you're analyzing, the actual tax rate and actual special assessments for that property. Don't just go off a rule of thumb. Don't just go off what the OM says. You can go, what I did was I just Googled Santa Clara County taxes. I found the website, I put the parcel. This property has 3 parcels. So what I determined the tax rate is 1.2676. All right. What we do, we come in, it's a calculation, equal purchase price times 0.012676. Now, here's the deal. That's not it. In the OM, that's what they did, and they came out with 153,049. After reviewing the property tax bill, I was able to see that there's 3 parcels. So each parcel has an amount of special assessments. And you have to check the bill to get this number. It's not a rate. It's the rate, the purchase price times 1267 and 672. Sorry about that. Now we have to add each special assessment, and you're going to see how this is a very, very important calculation. So I got 9757 plus 7180 plus 7359. Now, here's the deal with this. This is about $23,000 of cost that was not represented in our OM. I have a calculation of $182,000 for property tax. This is what your buyer will be paying for property taxes if they pay 2.5 million. I mean 12.5, again, if they pay. Their number, 153,049, about a $30,000 difference. If you capitalize $30,000 at 5% cap rate, that's $600,000 in value right there. This is why we take our time. Don't go off rules of thumb. We get the actual numbers, okay? So that was just one line item. We're going to keep it rolling. I'll pick up some steam here. I'm going to use their number for insurance, 12059. Insurance, sometimes you can even get it lowered if you bid it outright. Now, my number for off-site management. Here's another thing. Bigger buildings typically have off-site management and on-site management, 2 different numbers. In the OM, there's one line item for payroll. There's no line item for property management fee, which means probably the owner manages it, him or her themselves, and they hire the on-site and they hire the on-site maintenance people, and that's their payroll number. Well, 9 times out of 10, your buyer's gonna do the same thing, but they're gonna go hire a property management firm. And if they're not gonna hire a property management firm, the bank who's giving them that $8 million plus loan, they're gonna budget in their numbers. If they took it back, they don't wanna manage that. They're gonna hire a manager. So they're gonna they're gonna budget for off-site management. And what I did is took the gross income and times it by 5%. Some managers are going to be 6%, some managers are going to be 4%. What I find in multifamily, the bigger they go, the more that percentage comes down. But I use 5%. And I know a few managers in the Silicon Valley, and that's typically what they charge. And in California, you have a lot of rules to follow, so they have to get paid. However, my number for management fee of $49,000 is about their total number for payroll, which is $50,400. Okay, that's a problem. That's a problem because we too are going to have payroll. You have to pay on-site management and maintenance staff. Now, typically in this example, it looks like their on-site staff is being compensated by a free apartment. That was compensated in their economic vacancy, but they're also getting paid. Because once you can get away with a free apartment if it's 16 units, you got to start paying the money on top of the free apartment after 20, 30 units, certainly at 42 units in the South Bay. So what we're gonna do, I'm just gonna put a number here, and this is including maintenance, and this is including the on-site fee of 30,000. And that might be light, guys, but you probably, if you're gonna pay a firm 50, you can probably get away with 30,000 on payroll with the on-site fee. But that number may be light depending on how you're gonna operate. The key here, guys, is you're on a bigger property, you're gonna have off-site management fee to the company, but you're still gonna have to pay on-site people to manage to be the physical voice there, collecting the rents, serving the notices, to be the physical folks there, turning the units, handling the maintenance concerns. Those are hard dollar costs that have to be typically paid in addition to what you're going to see in, oh, here's a free apartment. Now, if you got 16 units, you can probably just give them a free apartment. Not going to work when you get 50, okay? Now, typically on the building like this, you're not paying workers' comp, but repairs and maintenance. Now, with their number for repairs and maintenance was 12,600. Again, that's an estimate, it's even. And then their number for turnovers was 12,600, okay? Totaling 25,000. Now, here's what I would say. What I find a lot when I look at the actual P&Ls is that the repairs and maintenance numbers ends up being very similarly close to the, if it's being managed by a company, very similar to the management fee, about 5% of gross. These numbers are pretty low. It looks like it's about 2.5% of gross, but we're going off what they're giving us, okay? We're gonna give them a benefit of the doubt in this example, but you need to, here's another jewel of wisdom. You want to look for the work order history for the last year. Ask them if they could submit to you the work order history for last year. Any major capital improvements, whatever you can get your hands on to look at maintenance. This is the one line item that is a serious wild card, and it changes on every property. You really have to dial into what's going on, okay? We're gonna, for example's sake, we're gonna just roll with what they have, 25,200. Now, they jumbled their utilities in one line item, and they said 56,412. So I'm just gonna take our utility costs here on the water line item, and put 56,417, excuse me, okay? Again, you need to verify the bills. Up front, before you're in contract, they're probably not gonna give you the PG&E bills, the garbage bill. But once you get in contract, you want to say, I want a copy of the bill to see where the property is at, and see if there's any wild cards. Also see if there's anything that is extremely delinquent, because sometimes when there's huge delinquencies, and I've learned this the hard way, is that some of those can get passed along to the new buyers, especially in a water, depending on where you are. My client purchased the property in Vallejo, and she inherited a large water bill. We thought it was not cool, but that's what it was if we wanted to turn the water up. So just word to the wise, review the bills. All right, their number was 56,417. Now, we are in California. If you're not in California, understand, but in California, it costs money to evict people. And on the OM, there is not a line item for legal fees, okay? I think it makes sense to budget in at least the cost of one eviction. And I'm gonna put $2,500 here. If anybody in the Bay Area, maybe I'm not paying attention to the chat, but if if anybody in the Bay Area, just California, throw a number of what you had to pay to evict somebody. I had to do a $3,000 one in Oakland. I know there's 4 stories of more than that. I'm just gonna put 2,500. You gotta have a number in there. They didn't have that in the OM, okay? So what I'm saying to you guys is make sure we want to be as conservative as possible. You might be a maverick in life, but when it comes time to running these numbers here, we want to be like an accountant, like an accountant who's never gone on a party ever in their life. We want to be so dialed into these numbers because, we want to under promise and over deliver, not the other way around, because what happens is it doesn't go good. Well, if you're a broker, and your buyer buys it, and then they're not happy, they're not probably going to use you again. But if you're the owner and you buy it, and it's your property, and now you're not happy, you know, that's even worse. You know, so be conservative up front. So I'm going to put a $2,500 number in there. They don't have it. Okay. Now, moving along. Advertising. In their number, they have $2,100 for marketing and advertising. We're going to leave licensing and permits alone. And then what we're going to do is they had a number for pest control and landscaping. They have a vendor number of $8,400. Okay. Then they have a general administrative cost of $8,610. Okay. Now, that totals the total expenses. And remember, guys, I was very lean on repairs and maintenance. In my experience, now this building looks like it did have a lot of capital improvements. So sometimes when a building gets completely renovated or updated, of course, the maintenance is going to be less. If the building is, you know, old and guy's not taking care of it, girl's not taking care of it, it's going to have more maintenance. So this number really varies. We're being conservative here at 25 too. But here's the deal, right? Our taxes were about 30 grand more. We budgeted for offsite management and onsite because that's what the bank's going to do when they look at your numbers. So you want to be on point with this. What did that do to our net operating income? I've got here 606. In their number, well, they had two numbers in the package. I'm gonna go with the high number. Their high number was 667,349. $61,000 difference, guys. $61,000. I ain't looked at a P&L. I haven't looked at their actual rent roll. Well, I'm just using their OM with our model, the CCIM cash flow model. This is just the first year shot, and we're going together slides. Do you see now the importance of everything that Helen just talked about and how that applies particularly to this part of the business? $61,000, when you capitalize that, and they're saying, I think 5.3 is their cap rate, the cap rate they're quoting. If we take 61, just 61 even, divided by 5.3, that's a 1.1 and some change $1 million value difference right there. And I'm not making this up, right? You might be able to get a property manager to come in there and do it for 4%, maybe 3%. I don't know. I don't think you can bet on that. I think if you can negotiate and maybe you own 10 properties, you can probably work something. But 5% is about the industry standard here. You gotta pay the onsite. They gotta fix stuff. Their payroll number was 50,000, and they did not have an offsite management number. You're gonna have it, or at least you have to budget. And let's say, here's the deal though. If let's say you budget that, and the owner says, no, I want to manage it myself. You say, fine, you can manage it yourself. Not what we advise typically, but even if you're gonna manage it yourself, your bank is going to put this in their numbers because they ain't gonna manage it by themselves. If they take it back, you know, we all know that. So you have to look at it through their lens. And if they do manage it themselves and they want to roll their sleeves up, then that's money that they can save. But you have to understand that the bank's going to put that in there. You need to put that in there. And we just knocked down 61 grand of the NOI, which took the property's value down $1.1 million. That gives you a little bit of negotiating leverage. Now, in the past few years, property gets listed, you just got to overbid to get it. But I think things might start changing up a little bit where you might actually have some negotiation leverage. And when you are in that process, you don't want to just be kind of shooting from the hip and saying, hey, you know, I want to drop the price down $500,000. I want to say, according to my numbers, I ran a thorough analysis. I came up with an NOI a little bit more conservative than you. You know, here's my offer based on the numbers, not just shooting from the hip. This model gives you a basis to do that, okay? Now, that's just the first year. Now let's look at the rest of the investment. And what I'm gonna do here is go to my assumptions tab. Our assumptions here, we're gonna stick with the vacancy rate, which I think is a little high for San Jose, but I believe this is high because they're inputting the free rent for their maintenance and management staff. okay? Rent income. Now, real quick question. In Oakland, I would use a 3%. I'm comfortable with using a 3% rental increase. We are in rent control environment. Helen, I don't know if you're on mute or not. Would you say in San Jose, is that safe given rent control 3%? Or
If
should
it's
we
already
knock it
at,
to 2?
yeah, if it's already at market rate, I would do 3% or maybe as much as 5%.
Right,
Rent control
right.
is
That's what I figured. So when I do my assumptions, I'll put rent growth at 3%, other growth income at 3%, and then expense at 3%. I just like to keep it all consistent. Know though, guys, that these things can switch. If we in California, for instance, say we have another drought, you know what happens in the drought, right? Water prices. You know, I saw that pretty significantly in a couple of buildings I was involved in when we were in the heavy drought season. So these things can change, but we're going to keep them consistent for analysis purposes. Now, when I come down here, I look at my cap rate. This is kind of the key to when we're looking at when we sell the property, what is that going to look like? And we've got to come up with that analysis in order to look at the internal rate of return, the T-bars that Helen showed you, and I'm going to go over. I'm going to use 4, 4.5 to 5. Now, in San Jose, I think a 5 cap rate is extremely high, and I think that's why the broker is marketing it that way. But I think properties typically, from what I've seen, between 4 and 4.5. Even Helen shows you something that was in the 3% in Sunnyvale. So in this part of San Jose, San Jose is a great city. This is a little bit more of a tougher area. I think it probably is the market cap rate is around 4.5%. So I put alternatives kind of a 0.5 point to over a point of what I think the markets could be a given market. Then expenses of sale, I always put 5%. You know, it's hard to get a 6% commission once it goes over, 3 or 4 million. So I always put 5%, and sometimes it's less than that. But there's also transfer taxes and other things. So these are the assumptions that we use to look at the holding the numbers over the holding period. Shows you what year 1 looks like, right? Here's our NOI. There's the debt service numbers. There's the cash flow before taxes. Now what we're going to do is go and kind of look at things. My spreadsheet is 5 years. Helen talked about 10 years. It's good to look at both, right? Every different strokes, different folks. I have some clients that they only like to hold 3 to 5 years. I have some clients that don't like to sell at all. So you kind of gauge that on your client. Now, I'm not going to go over every line item. I think Helen did an excellent job of breaking that down. I'll kind of just show you the top line and the bottom line numbers here. So you see the rent growth, and that's with over the years with kind of a basic 3% growth of rents, 3% growth of other income. Okay, but our expenses are still growing at the same rate, right? You'll see here, so our NOI is 605, 620, 24, 642. It's growing, okay? And then when we're gonna use the next tab, we're gonna look at what the sales gonna look like. We look at what the NOI would be in year 6. Helen mentioned in year, so if you're doing a 10-year analysis, that would be year 11. 5-year analysis, year 6. The NOI in year 6. Important number. I'll come back to that. So cost recovery. I always say talk to your CPA. If you don't have a CPA, you need to get one. You cannot be H&R blocking it in this level of the business. All right, you need to get a CPA, enrolled agent, somebody, and someone who's got some real estate experience. Okay, and let them deal with your cost recovery. And there's some things you can do there. All right, and this talks about, this shows here taxable income, and it's just showing negative. And this is, so you actually might be getting some tax love here, especially the first few years. You're not paying taxes, and then over here in year 4, you are starting to pay some taxes. First couple of years though, you're not paying taxes. All right. Well, actually, no, I'm sorry. You are. You're paying here at you're paying in this example, and everybody's different. That's why they need to talk to their CPA. They do show a tax liability. Okay, but here's where you basically can see things over 5 years. And this is also the importance of the cash flow model, like Helen mentioned.
Oh yeah, I was just about to say that this
when you can increase the income of the property, you can increase the value of it. You can increase the value. So that's looking at cash flow. Now, We want to know, did you, I know Helen, you were saying something. Did you want to comment?
Oh, I wanted to comment is that because you see the real estate taxable income is negative, sometimes that we have to adjust the down payment in order to make sense of this investment. So,
Right.
you know, yeah.
And you see, because when you're buying in a market like ours, where the caps are low, you know, it's not going to be a heavy cash flow investment. You know, the initial, the cash flow after taxes here is 180 grand, whereas the investment is 4 million and some change, right? Not a lot of money on that from a cash flow standpoint, right? But if you can figure out a way to increase the rents like your client did, and that's how a lot of people make a lot of money in the Bay. Let's just see what our example looks like. At the end of 5 years, in year 6, when we want to sell the property, we're going to take that NOI in year 6 at a 4 cap. That would give us a 17,562 value. The 4.5 cap, which is about where we are today, 15,610,813, and a conservative 5% cap rate, which again, I think that's high cap rate for San Jose. That's what our average is in Oakland, at 14 million. So either way, you see here, even in a conservative, a tight cash flow number, you're still making money. This is over $1.5 million. And this is the most conservative. I would like to look at the most conservative. You're still making over $1.5 million in that period of time. Okay, but then, and so I won't go over all these line items such as Helen broke down, but you'll see calculations of basis at acquisition, adjusted basis at sale, do the cost recovery, the calculations of capital gains. This is a good thing, by the way, though, to show clients if they're on the fence about doing an exchange or not. Again, exchanging where you can defer your capital gains. If the client sees that, hey, you know, I stand to pay, you know, capital gains taxes on $5 million, and they, you know, their gain is going to be different. Everybody's rate is different. They may think differently about just cashing out, and they may say, I need to do an exchange. Therefore, you can sell 2 buildings, you know? And if you're that investor, you want to know what this number is roughly before you go into the deal, because you may be planning on just cashing out. If that's cool, if you just have a plan for it. What's not cool is you get to the closing table and say, oh, I got to pay $1 million in taxes, not the plan. You know, that's not cool. So that's not what you want to do. Okay, but here's the breakdown of calculation of sales proceeds after tax. Again, rough numbers. Either, you know, you took $4 million and you made some money. Now, here's the deal. You made some money. Worst case scenario, over here, you took I think 4.5 million, turned to 6 million. But how does that compare in the marketplace? Well, now we look at our IRR tables, and what we call them in the CCIM world is T-bars, okay, because it's structured like a T. And this year 0, this shows your investment. This is how much capital you had to put down. Each year shows the amount of cash flow that you're earning. And then at what we call reversion, when you sell the property, this is the capital that you get back, your down payment plus your profit. And you see each alternative is different based on the cap rate. I like in the one in the middle is more kind of realistic, but if it works for me, if it works on the most conservative, then it's a great deal. So someone in the chat asked earlier, well, what does IRR essentially tell you? The IRR, the internal rate of return, tells you the overall rate of return when you include the cash flow from each year, and then the appreciation and principal pay down. Because when you sell the property, hopefully it's appreciated as it has here, and you've paid the mortgage down, and there's going to be a tax benefit or liability. This is you see here before tax. I like to stick with this number when I'm talking to clients because, you know, this is different for everyone, but at least this gives us a generic idea of what people will be paying in tax. But just let's stick with the before tax number. We're not CPAs. Best case scenario, you're going to make 18.81% over the life of this deal. Not bad. Not many investments going to do 18%. More realistic scenario, you're going to make 14.3%, 13% over the life. Still, where are you going to make that much return? But this is the one I like to key on. Worst case scenario, you're making 9%. Now it's like, okay, well, I don't know. You know, I like my IRRs definitely to be over 10%. Most people do, unless it's a really, truly nice trophy property. But this gives us now a point of reference of whether this is a good deal or a bad deal. So we can, you know, help our clients to make decisions. Does this fit what you're trying to do, Mr. and Mrs. Buyer? Are you going to be okay with the 9% IRR? Are you going to come kicking and screaming? Because I don't want you kicking and screaming. I want to be your broker for the rest of your life. Or if you're an investor, am I cool with this? Is this gonna make sense for me? Or is it not? Okay. That's the importance of what we're doing. That's the real world of CCIM. And I hope this has been helpful. Now what I'm going to do, I'm going to come to my last point here. And can you guys see here? Are you still, hold on one second. Hold on one second. Hold on. I'm going to show my concluding thoughts. Okay, everybody saying that? All right. First thing, always do your own analysis, no matter how good the OM is. You got to do your own. This OM we just did is with the top brokerage firm in the area. They are the top brokerage firm in the country, okay? So this is a well put together OM. Do your own analysis, okay? Now, second thing, request the actual rent roll so you can know what's going on for each unit. You kind of got to work with what they give you sometime, but you want to drill into what's real so you can know who's moving in and who is it all month to month, how many year leases we have, what do those deposits look like? Those are important details. And thirdly, this might be the most important thing. Do not loosely estimate property taxes. Please do not loosely estimate property taxes. I'm going to take this because here's the deal. You just saw a $30,000. I just showed you a $30,000 difference. Okay. You want to look up that parcel and you want to look at the rates and the special assessments, okay, for each parcel involved. Very important. All right. It was a $30,000 difference. $30,000 at a 10% cap rate is 300 grand. At a 5% cap rate is 600 grand. Not loosely estimate property taxes. On larger properties, there'll be costs for on-site and off-site. Always budget at least one eviction per year. And if you don't have to evict anybody, money in your pocket, but budget for it, okay? The listing NOI was 667 and some change. Our NOI was 606 and some change. So what that would do at the purchase price of 12.5, that actually pushed the cap rate at 4.8. Actually, not a bad cap rate for the market. And I think the way they put these numbers, they wanted to market 5% so that everybody is, I don't know what the status of this listing is, but I would imagine if I'm looking for apartment buildings in this price range in San Jose, I am all over this deal. Because even at a 4.8 cap in this market, still a decent cap rate. But you might be able to use, hey, you guys are marketing 5.3. I'm looking at the property because it's 5.3. At a 5.3 cap, it's not worth 12.5. That might be a strategy to get the price to a more realistic number. Okay. I put here the cash on cash here was 3.7%. That's not great, but a lot of people who invest in the Silicon Valley in the Bay Area are looking more so at the IRR than just the cash on cash because they're looking at appreciation over time. They're looking at getting the rents up, but you have to know what that is going in day one. Not the best cash on cash. However, it still represents positive leverage. The cash on cash is higher than the interest rate. And the cap rate is higher than the interest rate. That's important because you want to make sure you're making money on the bank's money. You don't want to lose money on the bank's money, okay? That's important. All right, and here's what I just said, which we already talked about. With the drop of 61 grand in NOI, if we use their market cap rate, now I'm telling you, the market is, and Helen, I mean, what would you say market cap rate is in that East San Jose? I'm saying 4.5. Would you agree, or would you say that's too high or too low?
Too low, probably East San Jose right now. I started seeing a lot more cap rates in the 5s these days.
Well, and maybe that's why they're putting it in the 5. And so if we're saying, hey, that is the market, if we say that's the market, then we can't pay 12.5. Because if that's the market and we're paying 12.5, our cap rate's 4.8. So we want to buy better than, we want to beat the street. We don't want to buy, we don't want to overpay. Okay, and this is a mechanism of helping you to be able to do it. So I hope these points help. I hope this class helps. I hope going through it kind of line item by line item, was helpful here. I'm going to stop my share. But I hope that this was an eye opener. I know from in my breakout room, I was talking to some veterans. So maybe that just was, kind of a recap. For some of you making the transition from residential to commercial, or from some of you just saying, hey, I want to sharpen my axe. Look at what we just found off their OM. Now, I bet when we pull their P&L and we pull their actual rent roll, it's even more, which is what you want to do. So the key here, use the CCIM cash flow model. This is the thumbnail sketch. This is a very, very elementary summary of what we go over in the CI 101 class. It gets real. One of the guys I was networking with was saying it's like drinking from a fire hose. It is like that. But when you get done with it, like I'm telling you, it's a game changer. No matter what you do in the business, I don't care what you do in the business. If you're in corporate real estate, just analyzing leases or managing a portfolio, managing buildings, or you're an investor, certainly if you're a broker, this is going to make an impact in your business. I highly recommend you at least taking the CI 101. So that's it. That's all I've got. And we wanted to leave some time for questions and answers. I know there was a few in the chat. Did you see any, Helen, that were pressing questions?
So Shika did ask earlier if you would recommend this analysis for 3 to 4 plex or strictly 5+ units. I shared that I would not use this for 3 to 4 because it falls under the sales comparison approach analysis. So I typically only use this for 5+ units.
Yeah. And if where you might use it is when if you're working with an investor who's looking at 3, who's only purely looking at income, right? A lot of people though who buy duplexes, triplexes, and fourplexes have different reasons for buying them, like what Helen just said. It's residential property. Let's just say you're buying that, and you said, "Hey, I know this information." You can apply it. The same principles apply, but the valuation certainly is different.
Yep. It's like kind of like the example I showed earlier, where my clients was selling at Santa Monica. We did use the analysis to show her about the cash flow, and the valuation came out much higher than the sales comparison approach. So yeah. I just could not. I said, like, yes, the income approach does show it, but sales comparison, I just could not, justify that value.
Right. And I think that's why this model, it's a model, right? And you can use it as a guiding light to business. Just where you're looking at things. And I think as advisors, we have a duty. Well, I think we have a fiduciary duty to represent our clients to the best of our abilities. And a lot of people miss the boat on these numbers.
Yeah. So Shiko asked, what would be the best offer price of this particular multifamily?
If you're saying, okay, she's asking what's the best. So you're saying 5. So you think 5.3, Helen, is a legit cap for that?
I think so.
Then I'd say, we said it was $1.1 million. I'd come in at 11.4, 11.5. Because now, reality of the market is they may not accept that. They may laugh at you. But if they laugh at you, that's not business-like, because you can show them how you got there. And I bet you if you looked at their rent roll and P&L, whatever they put in the OM is the most glossy, rosiest picture. When you look at their actual numbers, it's probably worse than what we just saw. But we just saw if we're running with that 5 cap number, then it's worth $1 million less than it's listed for. And let me just say this though, Ed Cerna is the listing broker. He's one of the best in the business. He knows what he's doing. He's been around for a long time. I don't want to put any salt on him, the company Marcus Millichap, you know, but we're just talking numbers here, right? So if we're gonna make an offer, we want to make we don't want to overpay. I'd say 11.4, 11.5.
Yeah. Especially you have to really see full rent roll, like
Yep.
what's going on. Sometimes before I even make an offer, I would ask for the rent roll.
Yeah.
See what's going on. And
Yeah,
then
me
are
too.
there a lot of subsidized tenants? I mean, right now it's actually a good time to have subsidized tenants, but previously
Great
it would,
time.
yeah, a lot of people didn't like it.
Well, and it's a trip. You mentioned that. So now on the marketing package, the OMs, what you'll see is people with Section 8, you'll see it as federally guaranteed tenants. This building has fair. So if you see a broker talking about federally guaranteed tenants, Section 8. Because now you're getting that rent, no questions asked. And so it's interesting how things change. But if you see that marketing language, you know what it is. You know, I love Section 8. Everybody's got a different opinion, but you know, you want to know that stuff. You know what I mean? And that's what the rent roll is gonna tell you.
Yeah. Well, it is 3:30 right now. Unless you guys have more questions, or Steve, do you want to share your contact information? Feel free to contact me.
The best thing, I do a lot of stuff on YouTube. So I've got Infinity Investments on YouTube where you can find me, Steve Peterson, on LinkedIn. You know, I'm really communicating better on those places now. And you know, I'm focused. I don't know what you guys are doing, what your pivot is in the pandemic. But my pivot is I've typically done a lot of cold calls. I actually am a weirdo because I love cold calls. I've pivoted into doing more content directed towards sellers and owners. And so that's my pivot. And we all got to have a little bit of a pivot here. So that's what I was. So hit me up YouTube, hit me up on LinkedIn. Let's network, y'all. Let's do some business and let's lead the charge in our industries, in our neighborhoods, in our areas, in our families.